Welcome to 27 Topics. 27 Topics is a program geared at community issues and problems. And today our topic will be on taxes. And we have with us from Krueger and Associates, Dave Krueger, CPA, Blake Krueger, CPA, and a little later on in the program we will have with us Bill Alvey, tax specialist from Krueger and Associates CPAs. Good morning.
Good morning. Good morning, Paul.
And welcome to the 27 Topics. And let's get started in talking about taxes. And right off the bat, let's talk about jobs and growth tax relief.
Be glad to, Paul. As you may be aware, they have a new tax law again this year called the Jobs and Growth Tax Relief of 2003. It affects a lot of people. It has a lot of provisions on it that hopefully will provide tax relief to a lot of individuals and businesses. One of the primary things is they try to get rid of what they call the marriage tax penalty, to where if you file a joint return, your tax would be no more than someone who be no more than twice the amount of a single taxpayer. And so, for example, for this year, the joint return, the standard deduction is $9,500. Comparing that to last year, it was $7,850. They've also did some work on the tax brackets, the computation of the tax itself, so that if you're in the lower tax brackets, they tried to equalize that also to the twice the amount of a single taxpayer. They also did some work with reducing the tax rates. For example, the 27% tax rate now is 25, the 30% is now 28, 35 is 33, and if you're in the upper tax bracket, it is now 35%. Probably the one biggest issue is the capital gains rate reduction from 20% is now 15%. The 10% rate is now 5%, and that's effective for gains after May 5th. Along with that, probably the issue that affects more people than anything else is dividends is now taxed at the capital gains rate, which in the past was always taxed at the ordinary rate. So it's a big benefit to a lot of taxpayers. And the other issues will be hitting throughout the session, and various people will hit on some of those other topics that that are important also. I might just hit on miscellaneous items that are things that change from year to year. As I mentioned earlier, if you take the standard deduction for filing jointly, this year the amount is $9,500. For a single taxpayer, it's $4,750. Head of household is $7,000. The maximum Social Security taxable earnings for 2004 will be $87,900. The personal exemption is $3,050. So there's a lot of things there that can affect things, and I think now Blake's going to hit things like some various credits that apply to the tax return for 2003.
Okay, thanks. First credit I'd like to discuss is called the Dependent and Child Care Credit. It basically applies to children under 13, disabled dependents, and spouses. Basically, you're paying someone else to care for your child so that you can work. That credit, is basically a percent based on $3,000 for one child and $6,000 for two or more children. The maximum rate is 35%, and that is if your AGI is less than $15,000, and that credit gets reduced down to 20% of your AGI or of your expenses if your AGI reaches over $43,000. The biggest credit now that everyone's been listening to or hearing about is the child tax credit. That's that one where in July and August of last year, that people got that $400 rebate, a refund, they call it. Basically all that was an advance payment of their 2003 credit. And that was based on 2002 figures. That has been increased now from 600 in 202 to 1,000 in 203. And that's for each dependent child who's under the age of 17 at the end of the calendar year. And that also now, and that $1,000 will be for 03 and 04, but it is reduced in 05, 06, and 07 and 08 to $700, and by 010 it will get back up to $1,000. There are phase outs on that, $75,000 to $85,000 for single, and $110,000 to $120,000 for joint returns. One of the big questions people have asked our firm is, okay, if the child is claimed by one person in 02, but claimed by someone different in 03, who gets the credit or the additional credit? Well, we have found out that if you got that $400 and you're a taxpayer 02 with that dependent, you get to keep that $400, and the person who claims that child in 03 also gets to claim the $1,000. It's a unique situation. Both the 02 taxpayer and the 03 taxpayer now will benefit by the extra $400. Adoption credit is something that's brought up occasionally, and it has been indexed for inflation in 03, and it's up to $10,160 for all eligible children, and that is also subject to phase outs of between $150,000 and $190,000. Another popular topic that we have and hear have a lot of questions about are the educational credits. First one, the most popular one, because obviously it's one of the bigger ones, is the HOPE credit. And that's up to $1,500 per year per eligible student. So it's possible to have more than one HOPE credit claimed on a tax return. It can only be claimed twice per student. And that's figured up 100% of your first $1,000 of qualified tuition and 50% of your second $1,000 of qualified tuition. And qualified tuition is basically defined as tuition and fees required for the enrollment or attendance of an eligible student at an eligible educational institution. That qualified tuition is reduced by any scholarship or grant that's excluded from gross income. Student needs to be half-time, and the credits awarded on advanced placement exams, they're not counted towards a 2-year limit. So you have to be less than 2 years of post-secondary, have 2 years of completed less than 2 years of post-secondary education in order to qualify. And that's a big question because people say, well, my son or daughter or dependent have received more credits based on their placement exams. Phase out on that is singles 41 through 51,000, and joint is 83 through 103,000. Another educational credit is a lifetime learning credit, and that's up to 20% of the first $10,000 of qualified tuition and fees. This one can be claimed for all undergraduate, graduate, and students who are not in a program leading to a degree if the education is for the purpose of acquiring or improving job skills. Phase outs are the same as the HOPE scholarship at 41 through 51 and 83 through 103 for the joint. However, you can't claim the HOPE scholarship if it's claimed for the same student if you're claiming the lifetime learning credit for that student. But it is possible to claim the lifetime learning credit and the HOPE credit if it's on different students. Next one is called the Coverdell Educational Savings Account. This is sort of like an IRA. It used to be called the Educational IRA. It's a non-deductible contribution up to $2,000 per beneficiary. It can be made for someone under 18. The contributions can be made up through the due date of the return, so that's kind of a unique situation compared to the other credits. It can be rolled over tax-free, so if you start this savings account and child 1 decides not to go on to college, you can pass on to child 2. And the earnings, though, if they're not used for educational purposes, they are subject to tax when the beneficiary reaches age 30. There are phase-outs, again, single are $95,000 to $110,000, and joints $190,000 to $220,000. the good news about the Coverdell is you can use this for higher educational expenses plus expenses K through 12. So if you're going through private schools and secondary, you can use that for that as well. It's good for tuition and fees, books, supplies, and equipment, room and board at the beneficiary's halftime. So it's possible now to use your Coverdell savings account, pull those earnings out tax-free to pay for room and board at that student's halftime, and then also use the Hope Scholarship the first year because you can use that extra money, not pulled out of the Coverdell, and to pay for that qualified tuition. So there's possibilities to combine those with the other credits as well. Another topic is a student loan interest deduction, and for 2003 that is $2,500. It's only interest paid for student loan, and the loan, they say, must be marked and stipulate that it is a student loan. If you get a loan and it's to pay for education but it doesn't say student loan, it does not qualify. May be used with other educational credits as long as it's not for the same expenses. There are phase-outs again. Singles is $60,000 through $70,000, and joint is $100,000 through $130,000 is the phase-out limit. One more thing that we'd like to discuss is the qualified higher educational tuition deduction. That's an above-the-line deduction. Eligible tuition, same as tuition for the Hope and Lifetime Learning Credit. And that is for $3,000 for 03, $4,000 for 04 and 05. And sometimes it takes some planning depending on the tax bracket you're in and phase-outs and income limits and those type of things to determine whether I'm better off taking the lifetime learning or taking the qualified higher education tuition deduction. The qualified tuition deduction has a limit, not a phase-out. It's based on basically if you're single, typically if your AGI is greater than $65,000 or dollar over $65,000, you are not eligible to take that. If it's joint, it's $130,000. Now in 04, they're going to switch to sort of a phase out. It's going to be if your income for single is between 65 and 80, you're eligible for a $2,000 deduction, and if your joint return between 130 and 160,000 is a $2,000 deduction. So they're decreasing the benefit, but increasing the income limits as well for that situation. Last thing is a 529 plan that allows anyone, regardless of their income, earnings, to make contributions to estate plans or even some mutual funds have their own plans out now on behalf of the beneficiary. It's a popular plan with higher income earners because the control remains with the contributor of that account. Funds can be shifted tax-free to other relatives, and the earnings accumulate tax-free, and obviously then if you pull out that money, that's tax-free as well, as long as it's used for the educational purposes.
Thank you, Blake, and I think we'll take a break now, and we'll be back to talk to Bill Alvey, tax specialist, and a little bit more with you, Blake, and you, Dave, after this break.
Thank you.
Thank you.
Welcome back to 27 Topics. We have with us on this segment, we have again Dave Krueger, CPA, and we have Bill Alvey, tax specialist. And we're going to begin with Bill Alvey, who will be talking about individual retirement accounts.
Thank you,
Bill.
Paul. Individual retirement accounts really haven't changed a whole lot from last year. The contribution deductions are pretty well the same. For a traditional IRA, it's still $3,000. If you're age 50 and over, they allow you a $500 catch-up contribution, so you can put $3,500 away. For 2005, 6, and 7, they are scheduled to increase a little bit. As far as if you're an active participant in an employer's retirement plan at work, you may be limited to whether you can deduct the contributions on your tax return or not. If you are filing a joint return, you and your spouse, if you're both covered, and your adjusted gross income is below $60,000, you have no problem deducting the full amount of the contribution. It starts phasing out at $60,000, and once you reach $70,000 adjusted gross income, you can no longer deduct the contribution. You can still put it in, but you just can't deduct it. If you're a single or a head of household, their phase out start at $40,000, and it's at $50,000, you get no benefit of the deduction. If one spouse is a participant and one spouse is not a participant, that is a little different there. The one who is not covered by a retirement plan, he can still, or he or she can still put the money in and deduct it as long as their adjusted gross income is less than $150,000. If it's over $160,000, there's no benefit of the deduction. There's also Roth individual retirement accounts. You put the money in, you do not get to deduct what you put in, but it grows tax-free. There are limits there to whether you can even establish a Roth IRA. If your adjusted gross income is below $150,000, you have no problem having a Roth IRA. If it's over $160,000, you cannot have a Roth IRA. That is for joint return.
I might inject one thing here. The advantage that Roth has over a traditional IRA is that the earnings come out tax-free. On a traditional IRA, they're deferred.
Right.
When the proceeds are taken out, then they're taxable. So there is a substantial difference, and Roth, I know, has been a very popular type vehicle to be used this time.
More and more of those are going out now the way that, because they're so popular. They have tremendous tax advantages, like
exactly
tax-free growth.
My question would be what is the maximum anybody can contribute into any one of these accounts?
If you're under age 50, it is $3,000. You can put a combination into traditional Roth as long as total doesn't exceed $3,000. If you're over age 50, like I said, there's the catch-up contribution of $500, so you can have $3,500.
Actually, it's age 50 and above, I think.
Okay, right, age 50 and above, right. So
and this is per individual.
Per individual, that's right, Paul, exactly. You're right. And so, Dave mentioned Roths are very popular, and a lot of people are going that way now. Another thing in the retirement section is how much you can actually put into your employer 401k plan at work. For 2003, the amount was $12,000. For 2004, it is $13,000. For 2005, it goes up to $14,000. In 2006, it's $15,000. Now, if you are age 50 and older, you get a little bit more you can put away into your 401k at work. You can put, in 2003, you could have put $14,000 into it. 2004, you can put $16,000 into your 401k plan at work. There's other retirement plans that are called simple IRAs or simple 401ks. There, you can put in, 2003, you could put in $8,000 into these plans. If you're age 50 and over, you could have put $9,000 into your simple plan. For 2004, the amount you can stick in is $9,000 if you're under age 50. If you're age 50 or older, the amount is $10,500. Now, in addition to those deductions, you could also possibly be eligible for the retirement savings contribution credit for the amount you put into these retirement plans. It is a non-refundable credit, meaning you can't generate a tax refund from this credit. You can reduce your income tax to zero, but you can't go below zero. Eligible contributions are contributions you make to your 401k plan at work, your Roth IRA contributions, your traditional IRA contributions, your simple contributions. Those are all eligible for this credit. Individuals who are under age 18 who are a full-time student or are claimed as a dependent on somebody else's tax return are not eligible for the credit. The credit is available to offset, like I said, both regular income tax, but it also is available to offset alternative minimum tax, which is another complicated issue, but it's good that you get to offset both taxes with this credit. The maximum amount that's eligible for the credit is $2,000 per eligible taxpayer. And the amount of your credit is dependent on your AGI, your adjusted gross income. So if you're a joint tax return and your adjusted gross income is between $0 and $30,000, you get a 50% credit of the $2,000, so you get a $1,000 credit there on your tax return. If you're head of household, it's between $0 and $22,500, you still get the 50%, and single up to $15,000, you get the 50%. Then it starts phasing, it goes down to 20%, 10%, and if you're a joint return and your adjusted gross income is above $50,000, you get no credit. Or if you're a head of household, if you're above $37,500, you get no credit. Or single, if you're above $25,000, you get zero credit. And your modified adjusted gross income for most taxpayers is their adjusted gross income. There is some things you have to add back, like foreign earned income, foreign housing costs, and other types of foreign income that you have to add back to your adjusted gross
When
income.
you're talking about foreign, we have, military people overseas now. Are they affected by this?
No, that would not qualify as foreign income.
Right.
Okay,
This would be people who are living abroad, working abroad, but not in the military.
not in in our government.
Exactly right.
Exactly.
And another thing about that retirement credit, if you're taking distributions from your retirement plan now, that will reduce your credit, or it may eliminate it altogether.
Okay, next, I guess, Bill, you will be talking a little bit about business and related taxes.
Right. The big thing that's new this year, it's not really new, it's just been raised. There's a Section 179 deduction which allows you to write off equipment as you buy it, boom, the first year you get it. And that used to be $25,000, and it was increased in 2003 to $100,000. I mean, you can take a first $100,000 of your equipment, certain vehicles qualify if they're over a certain poundage as far as weight, that you can write off as an expense, a business expense your first year, providing you have the income to do it. There is phase out to that. If you put over $400,000 of this type of equipment in, it gets reduced dollar for dollar for anything over $400,000. Also, there's bonus depreciation. It was 30% up through property you acquired through May 5th, 2003. That was increased to 30% for property acquired after May 5th, 2003. That is
50%, you said 30.
Or increase to 50%.
Right.
Excuse me. And that is in addition to the Section 179 deduction. So you get the Section 179 deduction, and you can take another 50% off of anything over and above the $100,000. So you get a pretty good write-off your first year on equipment, furniture and fixtures, like I said, certain vehicles. Buildings do not qualify for either the 179 or the 50% bonus depreciation. The self-employed health insurance deduction increased this year. It was 60%, I believe, in 2002. It increased to 100% in 2003. Goes right on the front of your tax return for self-employed individuals. It's also available to S corporation shareholders who own more than 2% of the company's stock. They are considered, for this purpose, self-employed.
Who is considered self-employed? If you are the president of a company.
That doesn't make you self-employed. You're getting
Okay.
if you're not getting a W-2, if you're not getting a wage, you're probably self-employed, like doctors or physicians of some sort.
Farmers.
Farmers are a lot. Yeah, farmers
Yes.
are a lot.
Okay.
The standard mileage rate for 2003 for the business purposes was 36 cents. That is increased in 2004 to 37.5 cents. The for medical purposes and for moving purposes, it was 12 cents in 2003. It is increased to 2004, or 14 cents in 2004. For charity, it remains 14 cents a mile in 2003 and 2004. The home office deduction hasn't changed since last year, but it's been relaxed a little bit because of the Tax Relief Act of 1997. You know, if you don't have, a lot of places, if you didn't have a place that was, you didn't have an office at your workplace, you really couldn't take the home deduction for offices. Now you really can, as long as you have something used at your home that's used exclusively and regularly for business purposes, you can take a home office deduction for part of your utilities, your insurance, your taxes, whatever. Now, the estimated tax provisions, again, very little change from before. If you're, on federal purposes, if your tax liability after credits for withholding is under $1,000, you must make estimated tax payments, or you'll have a penalty. You'll have an underpayment penalty under taxes. And you can either have 90% of the current year liability paid in, 100% of the prior year liability paid in, or you can use the annualized income method where you can figure your taxes each quarter to eliminate these penalties. That's for people who have AGI of under $150,000. If it's over $150,000, the same provisions apply, except you have to pay 110% of the prior year in order to eliminate any penalties. Indiana, it follows the same rules as the federal, except that the amounts that you need to have before you have to make estimated tax payments is $400 instead of $1,000. Farmers are a little different. If they don't have to make any estimated tax payments as long as they get their tax return filed by March 1st of 2004. They can pay all their tax with their tax return. Or if they don't want to do that, they fall into like all the other taxpayers and pay it quarterly with the estimated taxes.
Do the other deadlines for business and everything still remain corporations at March 15th?
Right.
This is
It's-
only farmers.
Yeah, only farmers is all that I'm aware of that get that special provision like that. Other corporations, other individuals, no. For Indiana purposes, there's a homeowner's residential property tax deduction that goes on there. You can deduct the lesser of $2,500 or the amount of property taxes you paid. The renter's deduction was increased to $2,500 in 2003. The exemption still stayed the same as last year, $1,000 per person. For certain dependent children, you get an additional $1,500 exemption. And for 65 or older, you still get the $1,000. And if your AGI is less than $40,000, you get an additional $500 for persons over 65. There was some recent literature we saw about the sales taxes on labor. That has changed a little bit starting in 2004 for Indiana. Some labor costs now are going to be subject to sales taxes.
Before we close, a couple of things I'd like to hit on. Social Security is always a topic that people tend to ask about. There's two issues. Number one, whether or not you're eligible for Social Security. The other issue is whether it's taxable. Eligible for Social Security, if you're drawing Social Security under 65 and you have earned income above $11,520 in 2003 or $11,640 in 2004, your benefits are going to be reduced. The year you reach 65, for 2004, the earned income is $31,080. Over 65, it's unlimited what you can earn. And earned is W-2 income, earnings from a business, a farmer, those type of things. The other issue comes to being whether it's taxable or not. And it can be taxable. If you're a single taxpayer and your adjusted gross income plus half your Social Security exceeds $25,000, it could be taxable. For a joint, it's $32,000. And if it's above $34,000 for a single or $44,000 for a joint return, it basically will be subject to 85% tax. Or 85% of it is taxable, not 85% tax. So that is something that we always have questions on. A lot of times we have questions when people retire. What happens to like a farmer who has income that he's got stored in his grain, or he's got grain stored in bins? What happens when he sells that? Hillary Blessinger, who also works with us at our office, tends to be very much an expert in those issues. That and also farming issues. He's the expert. So if you have any questions, we'd be more glad to try to answer those.
What is your phone number?
It's 482-4454, and our Ferdinand office is 367-2442.
I think we're going to take a little brief break here, and then we'll wrap it up.
Thank you, Paul.
Thanks, Paul.
Okay, I think that, this program went pretty fast, and we want to wrap it up here. Dave, I think you have some important things that we need to cover here yet.
Just a couple items. Planning opportunities, there's not a lot you can do after the end of the year, but you still can have an IRA you can still establish. You can think about Section 179 as far as depreciation write-off, bonus depreciation if you're in businesses and farmers. Those things are still available. I'd like to make a little plug for CPAs. You know, we are required to have 40 hours of education a year, so we're there trying to keep current as much as we can. Of course, the laws keep changing dramatically year after year. So, and one of the things too, we also, and everybody stresses electronic filing. We're trying to do electronic filing for our taxpayers now. It's something that the IRS is going to mandate, or they have mandated. So we've instituted that, and we're working very hard to have a lot of our taxpayers do electronic filing. So.
Very good. I would tell you what, our time is just about up.
Okay.
And we want to thank you for being with us this morning. With us this morning were Bill Alvey, tax specialist, Blake Krueger, CPA, and Dave Krueger, CPA. And I want to inform you now that, watch 27 topics and watch for the topics that we have each week, because this fall we will have tax planning programs so that you can plan better for your taxes in the new year.
That'd be great, Paul.
That'd be great.
Thank you.
Thanks.